Hey everybody, I'm Jay. This is smarthelping.com. We got a brand new financial model template here for you. This is going to be for a cleaning service that offers fixed price jobs or for a one-time fee as well as or recurring revenue contracts. It could be commercial, residential, what have you. And for all kinds of services, it could be for as simple as like gutter cleanings, power washing houses, could be lawn mowing, could be commercial cleaning services for a bunch of different buildings and businesses with recurring contracts on any term. So we'll go through all the assumptions, how you can build this out to build a 5-year pro forma forecast for the business's operations, figure out how much money you need, if it's a startup, or you can just project out future revenue, expenses, and cash flow of your existing business. So first we have, I'll go through each tab, explain how they work, and then go through the summaries. So first is global control. Here you just simply enter the company name, launch year. This could be any year. Make sure if you do change the launch year, you update your drop-down dates accordingly. These dates will update as this changes. For example, if this was 2025, okay, now you can see on the exit month drop-down, the dates updated here. Those will also update on the OpEx tab here, debt schedule tab, and CapEx tab. So you can see now it's 2025 instead of 2024, but you can select those after you change the launch year. We're just going to put it to 2024. You never want to change this date ever. This is automatic. It's just to define your timing. Don't change that. You'll have other assumptions here on the revenues to determine a dynamic start month for when revenue and expenses actually begin within the launch year. So don't change that. You've got the exit month, which you can define any month within the 5-year forecast. Whatever month you pick, that will stop operations. And then you can also choose to include a terminal value or not to sell the business. If you do choose yes, it will apply a multiple to the trailing 12 months of revenue, and that's going to be your exit value. Cash sources, debt, and investors' equity. We'll go through that at the end. The equity investment will come on the cap table tab. We've got taxes here, and then we have one global input for recurring revenue contracts, and this is if you want to collect that money up front or if you collect it evenly over the contract period. If you collect it evenly over the contract period, you'll put a no here. If you collect it up front, you'll hit yes. That will affect cash flow quite significantly. We also have some summaries, check summaries to make sure all of the different tabs match it and they all should zero out. Okay, so once you have this configured, we'll go to recurring contracts. So this is really simple. You've got 3 potential customer tiers that you're going to sign up. You sign up a given amount of customers per month based on whatever you input. And I found this, people like to use this style a lot more than something where you're defining like a start amount of customers and their monthly growth percentage. It's just more times than not, this is the easiest way for people to do it. So you can just simply define how many customers you're adding per month. So each tier 1, 2, and 3 has the same assumptions to configure. You can pick what's the average contract length of these contracts, what's the total value of the contract, and then the monthly amount here will auto-populate based on the month of the contract and the total value. You can also define if you're going to increase the contract value at each renewal by whatever percentage, if that's relevant, and the retention rate of customers in this contract for the term. So this means, if you have 100 customers that join in month 1, in month 13, because these are 12-month contracts, you only have 80% of those left, and it'll keep going forward every 12 months based on whatever renewal rate is here. And that can be adjusted over time based on customers that were added in year 1 versus year 5. If you think you can improve your retention rate or want to plan on improving that, you can do so with these percentages here. And this doesn't have to be 12. This could be 6. This could be month-to-month contracts at 1. Whatever. All you have to do is make sure that the total contract value here matches the term length of the contract in months here. And that will all work. You can see the year-ending customers, annual revenue, churn, and labor materials will all automatically update as these update. So if this were 6 months contracts, you can see the data updated here. And same goes for, let's say if these were 12-month contracts, you'll see this numbers here will start to go up with the longer contract term. You could also update this. Let's say tier 1 didn't start till year 2. Okay, you can see that updated. So very easy to manage. This is what I found to be the best way to configure these, and with the most flexibility and easiest for the user to adjust. All right, so those are recurring contracts. You may or may not be using that. Now, if you don't use any of them, that's fine. You could zero this out and just have no customers at all, and that's completely fine, and only do fixed price jobs. Now, if you're doing fixed price jobs, well, I guess first let's go to service personnel. So this is to scale with these recurring contracts, and what it does is it will count the total customers you have at each month. And then based on these ratios here, you can define how many service or support workers you need to support that contract. So in this case, for tier 1, I'm saying required service worker person per customer is a half. So what that means is one person could handle 2 customers. So if you had 2 customers, okay, we know that means I have to have 1 service worker of this type. You've also got required other support. So here we're saying 0.05, and at that point, it means there's 20 customers that can be handled per worker. So you don't need as many of these. You need a little bit more of these first ones, and then you could define the improvement in that ratio over time, if applicable, and the fully loaded salary of these workers, which will then update in the expense tabs. And the same goes for tier 2 and tier 3. And all this is trying to let you easily define is, okay, I'm going to add these customers over time. You know, I have to have workers go out and perform the work to do the cleaning services, and that's where labor materials is going to come in. The labor for this revenue stream is based on service personnel. And you just need to know how many people you need to service these contracts for each customer type. Now, let's say this was like 5. Now that would mean you need 5 people per customer, or for every customer you add, you're paying you're paying 5 service workers per month at this salary. We'll put that back to 0.5. These numbers will be specific to your situation and the type of service you're offering. The only other piece with recurring contracts is on the OpEx tab at the bottom. You can define the expected monthly cost in cleaning supplies and materials per customer, per recurring contract customer. So if there's, 100 of these customers, is $1,500 a month for supplies and materials to keep that account going, then it'd be 100 times 1,500 is the cost. And all those will populate over on the monthly detail, which we'll go through. But this section here is for the recurring contract, cost of goods sold. We'll get to the flat fee jobs now. So on the flat fee jobs, you've got the same input here, but now instead of customers added per month, this is the number of jobs you're completing per month of each job type for up to 3. And here is a little bit of different configuration. So on fixed price jobs, you just want to know what's the average price per job for tier 1, 2, and 3. What's the average pay per job per service worker? So this is saying you're going to pay your service workers a one-time fee to go out and complete a job. You're going to collect a one-time fee from the customer. You also might have multiple service workers. So this might be, if this was 3, in that case, you'd have to pay $1,050 for these service workers to complete the job. You're collecting $2,000 from the customer. And then also average materials cost per job. So materials, supplies, things like that. What's the average per job? And so this allows you to scale up to as many jobs as you think you're going to be able to handle. And then based on these economics, you'll see, we've got jobs completed per year, annual revenue, annual labor and materials costs. This also is going to be on a monthly granularity on the monthly detail. I'll undo that. Where was I? Here, okay. All right, so those are flat fee jobs. Now you have also corporate overheads. You might have insurance, legal fees, managers, things like that, marketing, ad spend. all sorts of different things. So this is what the OpEx tab is for. In each section, you just define the detail. You pick the month you think the cost is going to start, and then you define what the monthly cost is, and you can adjust that monthly cost over time. Now, let's say we're starting in a partial year. Let's say June 2024 is when we actually start marketing here. Well, this 7,500 is not going to start till June 2024, but you don't want to zero this out and have it zero, and then nothing's going to happen, even though you have this start month here, because you have a zero for year one. So you'd want to have that in here. This month defines when the month that the monthly cost actually starts. And the same goes for G&A and R&D costs. You've also got a function here for total monthly revenue, expenses based on that. So this could be credit card fees or any other variable costs that you directly want to tie to revenue. That would be an expense. Okay, debt schedule. So this is where we have terms of the loan if you're going to borrow any money to try to pay for these startup costs and operations. So on the global control, the model is going to tell you based on all your startup costs and any burn, operational burn, how much equity you need at minimum to keep the cash balance above zero. And then you could say, let's say this was zero. Okay, now we need $1,068,000. But if we want to take out loans, because loans cheaper money than equity, let's say we're going to take out a $300,000 loan. Okay, now we only need to come up with 800,000, and this will also increase the IRR of the project, assuming the loan interest rate is not as high as the return on the project. So like here, if this is zero and you go over to the executive summary, we can see a project level IRR of 96.7. So that we take out some debt, it's now 110%. And this is also important for investors because they're going to be giving, a significant portion. If you're doing a joint venture, the investors are going to be contributing a significant amount of the capital. And if you're only giving them say 10 or 20% of the profits, well, it's going to have the returns need to make sense for them. And so leverage is one way you can help increase those returns. Now there's also risk with leverage. It's just not like some magic tool that increases IRR. You have to make debt service payments on this, and then on exit, if you're going to include a terminal value, and then the full amount of this automatically is paid back. You can see here in the cash flow tab, we have the big payment here at the end to pay that loan back for principal payments. Okay, so that's the debt schedule, and you don't have to use debt. You could zero this out, and that's fine. CapEx. So this is fairly important if you're going to be buying, let's say, vehicles and initial equipment, and then it might be important as you scale and you have to buy more equipment. You'll put the month of expenditure here in column F. You select the month, whatever it is, and the total cost, and that's going to flow through to depreciation expenses and also affect the initial capital expenditures and cash required over time. If you want to try to roll this into operating cash flow, you would just keep an eye on like the monthly detail. You go down here and keep an eye on what your cumulative cash position is. And then you could see when you have a good amount built up. Like in this case, okay, we've got $1 million by September 2026. Let's say that's when you want to start adding more customers. So you would add more customers, either recurring contracts or flat or starting to do more jobs. You could increase that, and you would also correspondingly increase your CapEx on that month to account for the new stuff. So you can tie that together easily between those tabs. Cap table. So this is where we see, okay, our minimum equity required to get this thing off the ground is 800,000. You could enter who is contributing that capital from outside investors in this top section. So if you're raising money from other guys or any other people, you can put that here and their share of the business here in column D. And then this is bottom section is if the owner operator is going to be contributing capital, you can put that amount here in their share. I did do a filler here in cell C30 for overflow, and that's just going to take any amount of remaining capital from what's been raised here and above against this equity requirement. Any difference will go into here. So if you don't want to have to think about it and you're just going to say, okay, I know as an operator I'm going to contribute this much, this will tell you what's remaining to raise from investors and how much you're going to give them to the company to keep going. There's also IRRs over in this section to show the returns for the different investments, the IRR individually and as a whole investor group versus owner operator group. Startup costs, this is just things like legal fees, maybe an initial web design, any initial operating costs that are not depreciable, because you want depreciation costs in here in the CapEx table. But any other expenses that are coming in before operations start, you can put in here. Terminal value, this is just a tax thing. Let's say on the exit, we want a certain percentage to be counted as extraordinary income versus an amount going to the CapEx. In that case, that's just going to affect how much of your taxes are going to be applied to the income tax rate versus the long-term rate. And no, these are just arbitrary. This is obviously higher than this usually. But you could configure that, or you could just put 0% if you don't want to account for taxes. And it's just, if I haven't mentioned, all these cells that are in light yellow are what you edit. Everything else in white and black you don't edit, or that indicates that is a formula. So if you do edit it, it could break things. So just be aware of that. And I try to make it as simple as possible. As long as you're just editing the yellow cells, you should be good to go. All right, so that's all the assumptions. Then we roll over into the income statement. So you've got your recurring revenue contracts, your flat fee jobs, revenue from each of those, cost of goods sold, which is labor and materials for each type of revenue stream, your gross profit, your other operating expenses. Then we've got EBITDA, which is earnings before interest, tax, depreciation, amortization. Then we've got your interest expense, depreciation, our taxable income, income tax, and the net income. And you can see here on the exit, we have exit value, increased taxes on the month of exit, whatever that may be, and the final net income. We also show this on the income statement annual. Same deal as the monthly, but on an annual basis. We have balance sheet, which is just going to track, positions over time of cash, fixed assets, accumulated depreciation, debt, equity, retained earnings, and then liabilities plus owner's equity always will equal your assets. This is the check to make sure, and that goes out over time all the way to the exit. And balance sheet annual does the same thing, but on an annual basis. Cash flow statements, kind of like your uses and sources. You can see where all the cash flow is coming from per period. See the net change in cash, and this is what is defining your balance sheet monthly cash flow. And you can see, like I said before, we're solving for zero cash position, so this never gets below zero. You can see here in January 2025, that's when we hit zero based on all the different assumptions. And you can see how that corresponds on the monthly detail. That would be the minimum. If we go over here, that would be the minimum cash position we reach. What did I say? January 2025. So yeah, negative 821. You see we go negative 783, negative 821, and then 756. So it starts getting better there as we begin to turn a profit. So we're raising enough money to keep this above zero, and this is just the requirements of all projects. So monthly detail, also you're going to see your customers at the top, tier 1, 2, and 3, recurring customers, how many were added, lost in the ending count. You've also got the revenue from those contracts, which is going here, recurring revenue, and we're using that advanced retention rate. So there's a lot of logic going on here to find out how much revenue you are earning from these recurring revenue contracts. This is not easy to build, but I have perfected the mechanics to do that. A lot of that's from doing SaaS modeling, so similar logic. So you get your recurring revenue contract churn and churn rate and percentage, total revenue from recurring contracts, average recurring revenue per month per customer. You got your flat fee jobs down here, flat fee job revenue, and then total revenue, cost of goods sold. We're also showing the amount of reps you need of the different types, and these are to service the recurring revenue contracts. And then as we go down, we have materials and labor costs for the flat fee jobs, gross profit. You've got your other operating expenses, and then we're getting all the way down to EBITDA, debt service, debt balance, CapEx, exit proceeds, taxes, and final cash flow. And then we've got some advanced metrics here for the recurring revenue contracts. Here's where the offset is. So if I were to have collecting cash receipts up front, you can see there's now a big change here, and there's you see in the cash flow statement, we add the upfront collections, reduce the recurring revenue receipts accordingly. The executive summary tab is just going to show you a high-level view of the revenue, expenses, EBITDA, and cash flow all in one spot. Some charts here. You've also got a IRR, equity required, equity multiple, project ROI for the project, investor, and owner. Equity multiple is just your total return divided by total invested. It's always going to be 1x higher than your ROI, which is your amount of profit divided by the amount invested. Distributions tab is your discounted cash flow analysis. You can see the project level cash flow. What's the IRR on that? You could apply a discount rate to get a net present value. Also, the investor and owner's streams are the same style. You could define the discount rate for them. See the internal rate of return, net present value, and a chart for the investors and owners over here. Now, everyone always asks, how do you figure out what your discount rate is? And it depends on the business. It's a measure of risk. Usually people use weighted average cost of capital if you're going to get real sophisticated, and that's to determine usually what the cost of capital should be in the industry that you're modeling. One thing to note is the IRR, if you plug this into the discount rate, it will make the NPV 0, and that's a good check. And all that means is the IRR is actually the rate that you discount future cash flows at to make the NPV 0. So that's what the IRR actually is, in fact. So it is related to the discount rate in that way. Visuals, we've got key financial stats, yearly cash flow, monthly cash flow, cumulative cash flow, revenue by type, recurring revenue versus fixed price jobs, flat fee jobs completed per month, month-ending recurring contract customers, monthly recurring contract revenue, monthly revenue by type for the different flat fee jobs, type 1, 2, and 3, and then the advanced metrics for recurring customers. Alrighty, well that's all I got for you on this one. You can buy it in the description link below. I'll list it at smarthelping.com. You'll see this in the industry specific models here. Click on that. It'll be listed under the services industry models. Now, I've done a cleaning and janitorial model before, but that's just based on hourly wages, billables, and worker hourly wages. Much different than what we've got in the current model here, which is model based on recurring revenue contracts or flat fee. And I've never done that before for something like this. And I've always wanted to, but it was like, well, you can kind of do that with one of the SaaS models if you want it, but it doesn't have the flat fee component as well. So now I've got one template here, all connected to these financial statements, pro forma templates, that lets you do a forecast based on either recurring contracts, flat fee jobs, one or the other, or both. And it works in any of those situations just fine. So I think there's a lot of value here. I think that's like a service business is very common, and a lot of people do it, so it should be pretty useful. Alrighty, guys, like, subscribe. I'll see you on the next one.